stops them issuing at the longer end, or is it just a delayed process until they can get rates lower? And we'll come into that in a little bit. But is this a structural change that's going to ongoing? And because it's bills, that feels like ongoing stimulus, and it might change this whole cycle.
Well, I think the answer is that it continues until it doesn't. And the fact is, we know that these things always end badly because they tend to end in inflation.
And yeah, it's been my opinion, and probably your opinion too, that they're all in cahoots with each other. They all know that the problem they're facing, they're all facing the same problem, and they all tend to do the same thing at the same time. It's like, when I go back and look at, let's say, 2022, 23, 24, it seemed like they all decided to try and raise GDP growth via immigration, which then backfired. And now we've got the reverse of that. They do everything together, really.
Hey guys, welcome to Everyday Finance. Liquidity is what drives market growth and what causes market crashes. People put their money into risky assets like crypto, gold, and tech when central banks loosen up. When there is less cash on hand, pressure goes away. Now the most important question is, are we about to start another liquidity expansion? Raoul Pal of Real Vision and Michael Howell of Cross Border Capital are two of the best people to say what they think. For decades, Howell has been keeping an eye on global liquidity flows. Pal, on the other hand, has become a top expert on blockchain and macro cycles. In their most recent talk, they say the bull trend might have more room to run. The Fed is being careful with cash, but Japan, China, Europe, and the US are already easing. At the same time, money keeps coming into the dollar, which is still the world's most important currency for funding. They say that this mix is very good for gold, crypto, and tech stocks, which are the assets that are most affected by changes in liquidity. Pal and Howell think that the next 3 to 6 months will be very good. We'll talk about their main point in today's video, including how liquidity is changing, what the dollar cycle means, and why gold and crypto may do best in the next phase.
So let's dig in a little bit to the slowness of this cycle versus others. From our work is like, normally the liquidity cycle peaks around the business cycle peak. They're all, related. And the business cycle has been super low. If you look at the ISM, it's been below 50. And the strongest correlation to that is rates have been too high for too long. And that has kept the ISM lower than expected, which means it feels like it's elongated the liquidity cycle. So that's one factor that I'm looking at. The other one is the fact that they've been shoving everything into the bills market and not refining, in, let's say, the 5-year sector, that's kept this cyclicality. And I don't know if that structure is changing things because it requires ongoing liquidity as opposed to cyclical liquidity. So firstly, the business cycle and interest rates, and then, whether the structure of where they've been issuing makes a difference.
Yeah, well, I think the first thing is we don't seem to have a business cycle. And if you look at almost any economy since the COVID crisis, everything's kind of flatlined. So there's no obvious business cycle around. And, we can conjecture as to why that may be. Is it because fiscal policy is dominant? Whatever. But the fact is that there's none. There is a liquidity cycle, and that seems to be paramount. And the interesting point is, which I'm sure you'll attest, is that, financial markets are responded not to the real economy, they're responded to the liquidity cycle. That's what's going on. So we need to understand this, like it or not. It's become the paramount issue in markets as far as we can see. So I think that's true. And I think your point that about bill issuance is really critical. And, the way that we've sort of, I suppose, explained this before is to say what you're getting is a transition crudely from Fed QE to Treasury QE. And the Treasury are basically coming in and issuing a lot of bills. They're starving the market of long-dated coupons. So there's not the liquidity absorption that you would expect. People are being forced into the short end. Two things really come from that. One is that there is lower volatility in markets as a result. And in fact, we know the Treasury is very keen to actually keep volatility down, given the way they've upped these buyback programs. So that's significant. And if you get a lot of bill issuance and short-dated note issuance, the banks buy it with alacrity, because this is the sort of security the banks like that matches deposit growth And if the banks are doing that, they're effectively monetizing the deficit. So I think that's the route to a trend increase in liquidity over the medium term. We know governments basically have to find ways to fund themselves. And what better through this mechanism?
And do you think that this stops them issuing at the longer end? Or is it just a delayed process until they can get rates lower? And we'll come into that in a little bit. But is this a structural change that's going to ongoing? And because it's bills, that feels like ongoing stimulus, and it might change this whole cycle?
Well, I think the answer is that it continues until it doesn't. And the fact is, we know that these things always end badly because they tend to end in inflation. And that's the experience we've had in the 1970s. So it's going to go on as long as it does. And then it will be forced to stop, presumably, by concerns over an inflation pickup. Now, I think everything they're doing is trying to bury that inflation news by whatever means, fair means or foul. So we're never too sure what the inflation rate is. And I'm always, instructed by the fact that, one's personal inflation rate is always way, way above what you read in the CPI. So there's obviously a lot of manipulation going on anyway. But the fact is you've got inflating asset markets, which is really attesting to the fact that you've got strong monetary inflation. And monetary inflation is not just a cycle as we know, it's a trend. And that trend is accelerating. And I think what the world doesn't realize is that things have changed dramatically since COVID. We're in a world of monetary inflation, monetary debasement. It's not, as I keep stressing, it's not one of financial repression. It's one actually more, it's worse than that. It's actually monetary inflation. And you've got to start thinking about how to invest in a monetary inflation world. Yeah, it could be, but to be fair to the data here, the red line is looking at actually right across the long edge of anything from 10 years and above. So there's quite a lot of issuance there. But it is those longer dated issues that are really selling off. And that's what I'm trying to make the point, that it's not the mid duration or short duration stuff that is being affected. I mean, it's being affected to some extent, but it's nothing like, the gap is huge. And that differential, I think, tells you it's more about demand than supply factors.
And are the Japanese issuing a lot of long end stuff? Or is it just...
Not particularly, no.
So it's not excess supply.
No, it's a demand feature.
It's a demand. Super interesting. And that's one of the reasons, I guess, the Japanese stock market goes up as well, as you say.
Yeah, I think so.
And you wrote in a note this morning. I think that's a key thing, because you switch the long duration asset for another long duration asset that is a better prospect, I guess.
Yeah, I think absolutely right. I mean, certainly for mild inflation, equities look pretty good. If you get high inflation, they're not so good. You want real assets. But this is what you're getting. And in China, you've got, if you like, the opposite extreme, which is basically saying they're still in debt deflation, but they are emerging. This is looking at the Chinese 10-year bond, in orange, the yield. So that's kind of flatlining, but it looks to be breaking upwards, which is important. And I think the message here is that, not all increases in bond yields are necessarily bad. There can be good aspects to a rising bond yield if it's reflecting some sort of economic recovery or monetary inflation coming through. Some other assets can get a lift from that. And the black line is looking at the term premia in China. Now, normally you'd view a falling term premia as basically saying there's a big demand for safe assets, that investors are piling into government debt, bidding prices up and pushing yields down, and hence the term premia starts to drop. And that's really been the story, over that period since the middle of 2024. But you can see lately that there's been a flatlining and maybe even a breakout of that term premia. And that's important because, as background, what the Chinese are doing is that adding liquidity into their systems. And I think that's a critical thing to understand. And that liquidity is forcing investors out of safe assets, government bonds, into riskier assets like equities.
Raoul Pal starts by stressing how important the dollar is to world liquidity. Michael Howell says that the flows show that Washington may not want the dollar to be as strong, so that debt loads are lower. Trade-weighted figures show steady flows coming in, similar to what happened after the GFC and the Eurozone crisis. This makes the dollar even more of a reserve currency. This leads to a paradox. It's true that the dollar stays strong, but over time its value goes down. Because of this, investors are drawn to safe havens like gold and cryptocurrency. do well when liquidity expands and traditional money becomes less valuable. Howell's Financial Conditions Index shows that liquidity has been flat, but is now set to grow thanks to the Fed's careful management and rates policy. He says that worries about Treasury cash rebuilds, reducing liquidity, are exaggerated because the Fed has every reason to keep repo markets safe. Europe is adding money to the economy, Japan is keeping the value of the yen low, and China is putting money into the economy. All of these changes make the environment very good for risk assets. Now, the easy question is, how long can this expansion last, and where might the peak of liquidity happen?
Now, if you look at this chart, which is maybe a step to the side, but it shows what the issue is. Now, in our view, contrary to the conventional economic narrative, what really matters is the debt liquidity ratio, not the debt GDP ratio. I've never really understood what the debt GDP ratio measures, to be truthful, but the debt liquidity ratio is real because debt has to be refinanced. And if you don't have enough liquidity or balance sheet capacity in the financial sector, you can't refinance. Now, if you have high ratios of debt to liquidity, you get financial crises, or certainly stumbling economies and stumbling financial systems. And that's what China has really been through in the last few years. It's had way too high a debt liquidity ratio. Everyone recognizes the debt part, but they don't really see that actually liquidity has been quite scarce as well. And that's really been a function of the fact that Chinese have been trying to match a strong dollar. And they've been tightening liquidity on that basis. But that's caused them, economic woe. And what they need to do is to get that debt liquidity ratio down. Well, you can do it two ways. You can default the debt, well, fat chance of that happening. Or what you can do is to expand liquidity. And that's really what they're doing. So you've got to put this in context. And this is showing, the next chart is showing the growth of liquidity going through Chinese money markets. This effectively is the conduit from the PBOC, the People's Bank. And Chinese data is notoriously seasonal. So what I've done here is look at year-on-year changes to give you some sense as to what's going on. But it shows that there's a clear stimulus underway as of, these year-on-year changes, as of 2025. And that's pretty much coincident with the strong rally in the Shanghai market. So you're getting this impetus coming through, which I think is very significant.
Does it change much if you do year-on-year in terms of percentage change as opposed to RMB change? So what are they going to do about it? Because they're going to have to do something, right? We're not in a world where we can allow interest rates to become unanchored. And so there's something that either the government has to do or the central bank has to do eventually to quell this. And it can't be, it'd be unlikely to borrow money from the IMF. If it is, it's just another liquidity injection from a different mechanism. Yeah. But, what other answers do they have?
Well, I think the first thing they'll do is at the upcoming budget, they're going to start increasing taxes as best they can. The ability to cut back on expenditure programs is limited because in Parliament, the socialist sort of backbenches are voting out any attempt to cut spending. So that's tricky for them at the moment. But it may be that you have to force a crisis to actually get those cuts put in place. And clearly, if there is any deal with the IMF would be the baton that sort of is wielded to actually beat down spending. That's what they would do. The third alternative is the Bank of England just basically monetizes the debt. Let's not say never for that, because that's almost inevitably what's going to happen.
That's almost always what happens, right? That is the chosen path. And by what mechanism would they do that? Yield curve control?
Well, yes. I mean, it could be, or they just basically start to buy up. They do another sort of QE program, but these QE programs can be dressed up as support for the bond market in times of crisis, as they've done before. So I think that's the mechanism. Or they do it, as whatever one calls, what label one puts on it. But if you get the banks to try and buy more debt, that's another way. The private banks to buy more government debt, that's another route out. And they could try and loosen up some of the controls there. I mean, that's been spoken about. And you will note that, that it's not just the US which is talking about issuing very short-term debt and bills. The UK Treasury, as well as the Japanese, are talking about doing the same thing. So all these governments are sort of seeing what Scott Bessent has done and, lit up their eyes and say, well, what a great idea. Why didn't we think of that first? The trouble is it's monetization.
And it's been my opinion, and probably your opinion too, that they're all in cahoots with each other. They all know that the problem they're facing, they're all facing the same problem, and they all tend to do the same thing at the same time. It's like, when I go back and look at, let's say, 2022, 23, 24, it seemed like they all decided to try and raise GDP growth via immigration, which then backfired. And now we've got the reverse of that. They do everything together, really.
I think that's right. The problem, the immigration problems are becoming really a major issue here, for sure.
Yeah.
As they are on the face.
Raoul Pal and Michael Howell both agree that liquidity isn't reaching its peak this year. Their schedule points to the first or second quarter of next year. And Howell sees March 2026 as the most important month. That gives risky assets, especially tech stocks and crypto, at least 6 more months of fuel. Historically, these assets do better when liquidity grows. Gold has changed too. It used to be tied to real rates, but now it trades more like a monetary hedge with Bitcoin. As foreign currencies lose value, it does very well. Powell points out the difference with 2021. The cycle was cut short that year. But this time the window is getting bigger, which gives markets room to rise. Howell says that in the bigger picture, debt must grow along with cash. Since U.S. debt grows by 8 to 10% a year, and even faster during recessions, the long-term picture is one of constant money growth, weaker fiat, and rising demand for scarce hedges. It's easy for investors to see the theory. Bonds won't pay off, but investments that need to be liquid, like crypto, gold, and long-term stocks, are set to do well. If this holds, the next few quarters could be not only good for Bitcoin, but also for digital assets in general. As they solidify their place as core monetary insurance along with gold,